What is asset allocation? It's an investment strategy that balances your risk and reward in your portfolio according to your personal situation. This is done by having a certain percent of assets in equities and a certain percent in fixed incomes. This customized balance is one of the most important decisions for successfully achieving your financial goals. Before you do any investing, you should know what your asset allocation is. But before you find your optimal asset allocation, you need to know what your financial goal is. Long-term financial goals will be retirement, paying off your mortgage, and your children's education. So something that's more than 15 years away. Medium-term goals will be any goals that range from 5 to 15 years. This can be anything from saving for a down payment on a house or rental property, a wedding, dream car, or starting a business. Short-term goals will be anything under 5 years. So paying off debt, funding an emergency fund, a vacation, or having children. Now these time horizons will vary depending on many factors like your income, savings rate, etc. Okay, now that you know your financial goal, you can get a better idea of what your asset allocation should be. If your goal is retirement, you can start off with the 110 rule. Just take 110 and minus your age. The answer will be how much you should be in equities. So someone aged 30 should have 80% in equities. Then there's the age in bonds rule, minus 10. So someone aged 30 should have 20% in bonds. Or consider the general rule on age and retirement. If you're under 40, you can hold 100% in equities. If you're under 50, you should be 90 to 70% in equities. Under 60, 40 to 60% in equities. And if you're over 60, you should have 70 to 100% in bonds. Now these rules only take your age into consideration and are really only for retirement. To get a more customized asset allocation, you can fill out online questionnaires. The best ones are with Vanguard, Manulife, Equitable, and BMO Investing. These questionnaires will give you an asset allocation mix based on many factors, but all factors should be considered. These include age, financial goal, time horizon, investing experience, annual income, type of income, stability of income, saving investing rate, current savings and investments, debts, and your tolerance for risk. Factors like your age and time horizon will tell you how much time you got in the market. The more time you have in a market, the more risk you can take. Shorter periods of time have higher volatility and longer periods have lower volatility. So someone with a 4-year time horizon should have a more conservative portfolio. Factors like your investing experience and tolerance for risk will determine how you react to major losses. If you're new to investing, you might want to sell your shares when they're down.
First time.
Which is probably the worst thing you can do. If this is the case, you're better off with a more conservative portfolio with less volatility overall. If you have been investing for years, you know that when the stock market is down, it's a good buying opportunity.
Get in, loser, we're going shopping.
Factors like income, type of income, income stability, saving and investing rate, debt, and current assets will determine if you need to sell your shares prematurely. Someone with an overall stable financial situation doesn't need to poach from their portfolio. A fully funded emergency fund may be enough to get them out of any situation, while someone who isn't as financially stable might run into a situation where they may not have any other choice but to sell their portfolio. And this could be at the bear market bottom, which means you might need to take realized loss. So someone who is financially secure can take more risks, while someone with less financial security should take less risk. Now, what kind of expected returns are possible with different asset allocations? On average, equities return 10% a year, while bonds return 5%. Using these numbers, an all bond portfolio will return 5%. A conservative 60% bond, 40% stocks will return 7%. A balanced 60% stocks, 40% bonds portfolio will return 8%. A growth 80% stocks, 20% bond portfolio will return 9%, and an all equity portfolio will return 10%. Now this is on average over the long term. Actual returns will vary widely from year to year. And of course, past performance is no guarantee of future results. Knowing your expected returns can give you a better idea of how much you need to contribute to your portfolio to meet your financial goal in the time horizon allowed. Ultimately, asset allocation is up to you. Your recommended asset allocation is only meant to maximize profits while minimizing risks. But in the end, you need an asset allocation that will allow you to sleep well at night. If you're recommended a more aggressive portfolio but aren't comfortable with it, choose a more conservative one. You can change it at any time. And actually, you should reassess your portfolio every year to see if you need to change your asset allocation because of new or different factors. If you want to continue learning, check out one of the videos on the right of the screen. Thanks for watching. Until next time, keep making money moves. Peace!